Yeah, good afternoon. Good afternoon, friends. Today it is class number 8 and we will be on to financial instruments. The start of the class got delayed because of some technical issue. And I will share the screen. So, financial instruments. Where balance sheet items are classified into two as monetary and non-monetary. Monetary items are those assets and liabilities which are expected to be settled at the values at which they are stated in the balance sheet. Non-monetary items are other than monetary. So for monetary item, we have examples such as cash, accounts receivable, accounts payable, debenture, interest outstanding, bank overdraft, etc. So accounts receivable, the value at which they are stated in the balance sheet is the one that they are expected to be realized. Same is the case for accounts payable. The value at which it is stated is the value at which we will be effecting payment. Debenture, the value at which it is stated is the value at which they are got to be paid. Bank overdraft, etc. All these will come under monetary. Example for non-monetary or inventory, investments, PPE, equity share capital, and other equity items. So this is the way we have learned in the AS 21. But when we have to study something in financial instruments, we are expected to do the analysis as financial assets and liabilities and non-financial assets and liabilities. So in this particular case, can we take up monetary and financial as one and the same? Answer to that question is in the negative, no. If we have to treat monetary and financial as one and the same, then why we should have two different terms? So financial items, that is financial assets and liabilities, are items which you can say that majority of that you derive from monetary, but there are some items that we are going to take it up as non-monetary also under financial. What are those? Cash, accounts receivable, accounts payable, debenture, interest outstanding, bank overdraft. All this will come under that category. Then investment in other companies' debt and equity. So these items, especially this item, inducting investments in other companies' debt and equity, is to be considered as a very important input to classify an item as financial or non-financial. So other than financial or non-financial items, inventory, then PPE, equity share capital, investment in property, prepaid expenses, provision for warranty, then tax liability, deferred tax asset, refund due, etc. So all of you please be careful. Inventory, PPE, equity, share capital were all correct. Investment in property is also understandable that it is coming under non-financial. But why would prepaid expenses, provision for warranty, tax liability, DTA, refund due, or to be taken up under non-financial? Especially the tax liability will involve outflow of money. Refund will also be resulting in inflow of money. Why would these items are to be excluded from financial? One important thing that you should be remembering is that only those items which are coming out of contractual obligations and the rights, contractual obligations and rights alone will be forming part of financial instruments. Tax liability is not a contractual item. Government is not entering into a contract with their citizens that they should be paying tax. It is a mandatory thing that a person need to effect the payment when there is a earning. Simple as that. So, the foremost thing in the case of financial instrument is that there should always be a contract. How do we know that it is out of contract or not? In fact, the very term financial instruments, when you call it out as an instrument, instrument where you can say it is a document. See, whenever you have an item called as bill of lading, bills receivable, bills payable, promissory note. So all these items, people call this as negotiable instruments. The term instrument should be understood that there should be a contract between two parties which will result in right or obligation or both between two parties. So one need to understand that in order to have an item to be taken up under discussion as part of financial instrument, it should be documented or there should be an agreement. See, in fact, when we say as document, it need not necessarily be in writing. So just for the sake of introduction, I've just said it should be documented. That does not mean it should always be in writing. Even oral agreement can also be taken up there for the purpose of this financial instrument. So please just understand that whenever we talk something about financial instrument, understand that there should be a contract between two parties. And all these non-contractual items, statutory items will not be taken up under part of financial instrument. So this is what firstly we should understand. So what are the items that will come under financial asset and financial liability? Financial asset, the other one being say number one, cash balance. Next one, investment in other companies, debt and equity. Then right to collect cash or other financial assets. Next one, exchange of financial assets or financial liabilities which would result in favorable position. So cash, investment in other companies, debt and equity, right to collect cash or financial asset, exchange of financial asset or liability, which would result in a potentially a favorable position. Potentially favorable position. And lastly, usage of own equity instrument. See, I'm not just going into on a item by item basis, but these are the items which will be taken up as part of your financial item. In financial liabilities, against this you will not be having matching item. So when I say as right to collect, here we are going to say obligation to pay, cash or financial asset. Next one, exchange of financial asset or financial liability which would result in potentially unfavorable position. Then usage of own equity instruments. So these two exactly matching. Here also we would be having. So one can easily take up what could be financial asset and financial liabilities. Now, next one is about classification of financial assets. Financial assets. There are three types of classification that you have. One is at amortized cost. Financial assets through OCI, through profit and loss account. So to classify financial assets to be classified at amortized cost, we got to follow, that is we have to follow BM, business model test, pass is required. Business model test, pass is required. Then we do have collection principle, there is CPPI. What is that? Rajabala? CPPI, yeah. SPPI. What do you mean by SPPI? Solely for the purpose of principal and interest. SPPI. So the business model test that you have here and the business model test for OCA are not same. They are not same. Whereas SPPI test for both amortized cost and fair value through. So in fact, I've just forgotten to put that fair value through. FVOCI, FET, P&L. So what do you mean by business model test? So in an item where we are going to take up no conditions to be satisfied. No conditions are there to be satisfied. Business model test where for the financial asset you hold till maturity. In this, hold till maturity, or if opportunity is there to sell, it can be done. If opportunity is there to sell, it can be done. Here we do not have that thing. Held till maturity should be there. HTM. What is it you expect for SPPI test? SPPI test in which cash flow takes care of time value of money. Interest rate is pegged on a variable base. That is inflation base. So that means when inflation is high, interest rate will also be high. It can't be on a base other than inflation. That is not other than inflation base or index as the case may be. Even zero rate is also acceptable. Interest rate is pegged on a variable base, that is inflation base, not other than inflation index. Even zero rate is also acceptable. Okay. See, there can be a lot we can update. So at this moment, I'm just keeping it only to the extent of those 3 items. So what is that we are expected to do in the case of amortized cost? What do you mean by amortized cost? Say amortized cost would mean no change is made, there is no adjustment is made. I will put it like this way. No adjustment is made for the changes in fair value of financial assets. So no adjustment is made for changes in financial assets. So immediately think for a moment that your case is like a debtors account. To balance brought down, to sales made by sales return, by bad debts. You call it as impairment loss, by discount for yearly payment, to interest for delayed payment, then by cash, whatever, seller. By cash, by balance carried down. So this is the way we will be arriving at as the balancing figure, isn't it? To balance brought down, opening balance plus sales plus interest, sales return, etc. So one important thing is that initially that financial asset shall be booked at fair value. Subsequently, fair value changes will not be affecting will not be affecting will not be affecting financial asset. So have that in your mind. Whereas for fair value through OCI and fair value through P&L account, changes in fair value shall be captured. Is that clear? So this is what we are expected to do for financial assets. Now, we were talking about for financial assets only. Now, let us just take up for financial liabilities. What is it we are expected to do in the case of financial liabilities? So, financial liabilities are classified into two. One is amortized cost. The other one is fair value through profit and loss account. So, remember that in the case of financial asset, this will come under residual category. Whereas amortized cost is a residual category. So we can understand this much better once we start doing more about financial assets. Okay. Now, I would like to take up a few problems from Institute study material. Not, I would just run through every problem. That is not possible. Only for problem solving alone, when we are taking it up, it may not be appropriate. So therefore, some basics are expected to be worked out. So without which we can't be proceeding. Okay. Now let me just take up the Institute study material. Gopal, இதுலேருந்து நல்ல நல்ல ப்ராப்ளம் சொல்லு. It comes in schedule, that is module 3. Say I would like to take up on to illustration number 3. Entity B sells goods to customers on credit. Entity B typically offers customers up to 60 days following the delivery to make payment in full. Entity B collects cash in accordance with the contractual cash flows of trade receivable and has no intention to dispose of the receivable. Evaluate the business model. So, illustration number 3 as how it is to be handled. Say the question what they asked, evaluate the business model. So, I just don't answer only to that. So, whatever possible outlook on this particular case study is how we take it up. That we will try it out now. See, number one. First point is that we have got to firstly tell that it is a financial instrument. How do you say it is a financial instrument? A financial instrument will result in financial asset for one entity, and the same will be a financial liability or equity of another entity. Or another entity. Financial instrument will result in financial asset for one entity, and the same will be financial liability of another entity. So, arising out of a contract. Arising out of a contract. So, who is the buyer, who is the seller is not required. So, the two items that you have. So, financial assets in the books of entity B. Financial liabilities in the books of customer. So, therefore, it is a financial instrument, first and foremost thing. Then number two, business model is to hold till maturity and having no intentions to sell. So, business model is to hold till maturity and having no intentions to sell. No intentions to sell. Hold till maturity, having no intentions to sell. So, therefore, financial asset in the books of B shall be classified. Paper or pictures. Shall be classified under amortized cost. That's it. Now let's know as what they have just mentioned. B's objective is to collect contractual obligation, and so in fact I should say there's one more thing. SPPI test is also passed. How come test is also passed? So when nothing is mentioned, we should normally be understanding that payments made in advance will qualify for discount, and delayed payment will always be charged with interest. So now let me just take up. So here is a place where we have classification, overall concept, amortized cost, fair value, to other comprehensive income, then to profit and loss account. Okay, this is what I was just telling, that business model, contractual, SPPI, and all that we were talking about. Okay. SPPI is the one that we are talking about. So illustration number 12, I'm taking it up now. hold to collect business model test. Illustration number 12. An entity purchased a debt instrument for 100,000. The instrument pays interest of 6%, 6,000 annually and has 10 years to maturity when purchased. The entity intends to hold the asset to collect the contractual cash flows. Evaluate the business model. Illustration number 12. So, for this particular company, for the holder, it is a financial asset. For the issuer, it is a financial liability. For the holder, it is a financial asset, and for the issuer, it is a financial liability. Since it is arising out of a contract, this instrument shall fall under financial instruments. Next, business model is to hold till maturity, and SPPI test is also satisfied. Financial asset in the books of the holder, shall be classified under amortized cost. So entity objective is to hold the asset to collect the contractual cash flow, not to sell the asset before maturity. Thus, the instrument would meet hold to collect. Hold to collect is what I have written as HTM, hold to maturity. Correct. Then illustration number 13. So it looks the same, but there is some change in the wording. An entity purchases a debt instrument for 100,000. Booking it. 100,000. The instrument pays interest of 6,000 annually and has 10 years to maturity when purchased. The entity intends to hold the asset to collect the contractual cash flow. 6 years have passed and the entity is suffering a liquidity crisis. Needs to sell the asset to raise funds. Evaluate the business model. See, understand the classification is a test that you got to do it only at the initial stage and not at every stage. Let me tell you, the classification to be made as at amortized cost or fair value through other comprehensive income or fair value through profit and loss account should be done only at the initial stage and not at every stage through the contract. So therefore, the answer is going to be the same as it was just done. Here I wanted to tell classification is always done at the inception of the contract. So breaching the commitment marginally cannot be taken seriously. Breaching the commitment marginally cannot be taken seriously. So what do you mean by marginal commitment? Though it was not the intention of the question, let me tell you, marginally it cannot be taken seriously. That means ignore. A small amount of breach you ignore is what you can tell. Why? See, imagine the instrument that you are holding or the issuer is suffering some amount of financial crisis. So the prudent businessman is to foresee the difficult moments and sell the asset, sell that investment and keep the money in a safer place. So you can't be telling, sir, I have already committed, so I will continue to be with the company issuer. And in case of any insolvency, let me suffer because I have committed at the very initial stage. You can't take it up like that. So what I am trying to say is that you shift your investment and you hold it for the remaining period with some other case. And one more thing is that till maturity need not necessarily be the maturity of the instrument. See, if I have an intention to develop our own funds in a period of 4 years from now on, so that the money that we are holding is used for meeting some obligation or meeting some capital expenditure. So imagine that I am holding one instrument for where I have decided to hold it for 4 years period. Within 1 year of my holding, if there were to be some mishap with that investment, so what a prudent businessman I should do, I will sell the asset off and buy another asset in its place and continue the journey for the remaining 3 more years to meet that particular obligation or capex. So do not get excited that holding till maturity as holding till the maturity of the instrument. No, it is not necessary that we need to hold it till maturity, but general perception people carry when we say as held till maturity is only with the instrument, but need not necessarily be the same in all cases. You can hold the investments for less than the instrument's maturity, but you will have your own maturity to meet some obligation or capex. So that you should be remembering. Let me repeat once again. Generally, when we say as held till maturity, people will perceive that it is held till the maturity of the financial instrument. Need not necessarily be like that. You got to be very careful with that. So, because these are the wrong comprehension people carry. So the instrument may be lasting for 6 years, whereas I have the requirement of holding the instrument only for 4 years. Because at the end of the 4th year, I got to meet some liability or I got to pay for something where I got to have a capital expenditure. So I will hold it till my maturity. Money is locked up only for my requirement, not for the requirement of the issuer. I am not running my life for somebody else. I am running the business life, etc., only for my requirements. So don't think that we are selfish and all that. So in business, you need to be selfish. Nothing wrong to be selfish there. We cannot be doing charity when we are doing business. We can't do business when we are doing charity. So always remember this important point that maturity need not be associated or attached with the instrument. Maturity can be associated with the project for which you are holding this investment. Have that in mind. So breaching the commitment marginally cannot be taken seriously. Subsequent breaches cannot change the classification. Change the initial classification. Extremely sorry. Okay. So therefore, illustration number 13 also we have just completed. So now let me just pick up because we have just made note as what problems that we are going to do. I've just made a bookmark. So now let us just take up on to no problem. There are two problems, illustration number 24 and 25, both are there. See, when we are talking more about amortized cost, it is better that we report through a problem. Okay. So we will take up on to illustration number 25. Accounting for assets at amortized cost. A Limited has made a security deposit whose details are described below. Make necessary journal entries for accounting of the deposits in the first year and the last year. Assume market interest rates for deposit for similar period is 12% per annum. Date of security deposit starting 1st of April X1, finishing 31st of March X6. Description lease, total lease period 5 years. Discount rate is 12%. Security deposit is 10 lakhs. Present value factor at the 5th year is 0.567427. So in whose books this item has got to be taken up? So A Limited made a security deposit. They have made a security deposit on 1st of April. So where they are getting 10 lakhs at the end of the period. Correct? At the end of the period, we want this to be taken up. At the time of initial transaction, how the matter has got to be taken. That is the one that we are expected to carry out now. Now let us just take up illustration number 25. So A Limited deposited security deposit. So when there is no financial instrument, when financial instrument is there, how the same will be handled? When there is no financial instrument, we would have debited debit security deposit 10 lakhs, credit cash 10 lakhs. This is the way the journal entry we would have passed prior to knowing financial instruments. Now you can't do like that. So the deposit is carrying no rate of interest as you understand. So market interest rate is 12%. There is no other information that they have provided that this is going to fetch them any rate of interest. So therefore, this will not come into operation at all. So debit what? Debit what? And credit what? And how the difference has got to be taken up. So A Limited deposited security deposit, credit cash 10 lakhs. Under what head we have got to take up? So security deposit, what is the value at which it is to be taken up? They are given in the problem. 5 years later, the value is going to be 0.427 into 10 lakhs. So this sum is receivable only 5 years later from now on. So 5,67,427 is a security deposit. What is the account head under which the remaining figure has got to be taken up? The remaining amount as under what head this item is expected to be taken up? So the item can be taken up as loss or asset. Under what head it is to be taken up? 4,32,573. Under what head it should be taken up? So understand for what purpose this deposit is kept. So it is something like we find people occupy a place by paying a lump sum which will carry no rate of interest. Of course, the money is being paid only for the purpose of rent. So therefore, it cannot be considered as an loss. It should be taken up as an asset. So this entry is expected to be passed by year 0. Year 0, A Limited deposited. This sum is receivable 5 years later. So the present value of the money that I have to collect 5 years later, I have taken up at 567,427. Whereas I have paid 10 lakhs. The remaining amount is to be taken up towards prepaid rent. So when I say asset is a generic term. So it is prepaid rent. So which rent I am expected to be amortized over a period of 5 years. So by year number 1, we have to take up this as interest accrual. Though you are not receiving any amount of cash, debit security deposit, credit interest income. 12% on 567, 427. 38, 68, 91. 68091. Then amortization asset. So 432, 573 divided by 5. 432, 573 divided by 5. 86,515. Debit depreciation, credit prepaid rent, or debit rent, credit prepaid rent. 86,515. 86,515. And there will be no amount of cash paid or received till that maturity. Now, whatever we have just done, I would like to put them in the form of Excel. Now, let us just take it up. Year number 1, 2, 3, 4, and 5. Opening outstanding. Interest income, cash flow, then closing outstanding. Opening outstanding, $567,427. $567,427 interest round this multiplied by 0.12, 0. 68091. Cash flow is 0. Your opening balance plus interest income minus the cash flow is going to be 635,512. Then opening prepaid rent. So rent, then closing prepaid rent. $10 lakhs minus this. This is going to be So interest income, cash flow, this. So now let us run for 2 more years. Same way. Here, the cash flow is going to be 10 lakhs. This figure is going to be 10 lakhs minus this number. Right. Here, it is going to be this number and it is going to be 0. So, this is the way the matter will be running for a period of 5 years. And for 0th year and for year number 1, we have just taken up this transfer to profit and loss account, interest income, debit interest income, credit P&L, 68091, 68091. Transfer of rent to P&L. Debit P&L 86515, credit rent 86515. So therefore, the sum that you are transferring in each one of those years, when you total up, let's see as how much is that we are ending up with. Interest income is this. Rental income is this. Both are having 0 effect. $432,573 is the credit to P&L account. This is the debit to P&L account. It will match for a period of 5 years, but they will not be matching on one-to-one basis in each one of those years. So this is what you have for illustration number 25. Illustration 25. So we have just done problem number 3, illustration number 3, illustration number 12, 13, and 25. 25 just done with the help of Excel. Now let us just see what is that they have just given in the problem. So prepaid lease expenses, interest income, depreciation. They called it out as depreciation, whereas we have called this as rent. Then deposit income in the last year, 107, 143. 107, 143. And the last year depreciation and the sum was paid, 10 lakhs you paid. So with that, illustration number 25 is getting over. Right. Now let us just see as what could be the next problem that we can take up. Say I have bookmarked all this. Now let us just take up on to after this illustration number 31. See this problem number 28, illustration number 20 is very important. Let us just take it up before we could take up on to 31. XYZ Limited is a company incorporated in India. It provides INR 10 lakhs interest-free loan to its wholly owned Indian subsidiary company ABC. There are no transaction costs. How should the loan be accounted for in the Ind AS financial statements of XYZ and ABC and consolidated financial statements of the group? Consider the following scenario. The loan is repayable on demand. The loan is repayable after 3 years. The current market rate of interest for similar loan is 10% per annum for both holding and subsidiary. The loan is repayable when ABC has funds to repay the loan. So, XYZ Limited is a company incorporated in India. It provides interest-free loan to their wholly owned subsidiary ABC. How should the loan given be accounted in the books of XYZ, ABC, and consolidated financial statement if the loan is repayable on demand? Then B, if the loan is repayable after 3 years, the current market value of the interest for similar loan is 10% per annum for both holding and subsidiary. The loan is repayable when ABC has funds to repay the loan. Now, let us just understand what exactly is to be done. Scenario A, when it is repayable on demand. See, since the loan is repayable on demand, its fair value equal to cash consideration given. The parent and subsidiary recognize financial asset and liability respectively at the amount given. Going forward, no interest is accrued on the loan. Upon repayment, both the parent and subsidiary reverse the journal entry made under origination. So what do you mean by that? So when it is repayable on demand would mean it cannot be taken as the payment is made for a particular term. So for amortized cost, to classify a matter under amortized cost, the first and foremost test that you have in business model is hold till maturity. There is no maturity available. So it cannot be taken up there. It cannot be taken up there. I mean, business model test is failing. When business model test is failing for both amortized cost and fair value through other comprehensive income, by default, it will be falling under fair value through profit and loss account. So when you find even one condition is not satisfied, you cannot take it up under amortized cost. Both the conditions are to be satisfied. I mean, the business model test should also be passed. The SPPA test should also be passed. So if you find one of the two is not satisfied, you don't have to look into the case as whether it is satisfying the second condition, SPPI. See, it is something like in cricket, we have the bowler had bowled that delivery as no ball. So the umpire had given out and the batsman had gone in for DRS, decision review system. Decision review system has got to be exercised within 15 seconds of giving the decision, which has got a period. You can't be just taking the demand as you like. Within that 15 seconds, he is doing that. So the umpire did not notice that there was a no ball. But when they start to check up with the third umpire with the help of technology, we find very clearly the foot of the bowler is above the crease. Now, he will not be checking up the tachometer, sneakometer, or ball tracking and all that. Why would I just take up sneakometer and ball tracking when the delivery itself is not appropriate? Why would I just take up the other conditions as whether they have satisfied or not? All the conditions are to be satisfied. When the first condition itself is not satisfied, I will not look into as whether it will come under amortized cost or through other comprehensive income, straight away it will go into fair value through profit and loss account. That is the reason as why they say it is payable on demand, fair value equal to cash consideration, parent and subsidiary recognize financial asset and liability respectively at the amount of the loan given. So initially, whether it is under amortized cost or under OCI or through profit and loss account, they are initially valued at fair value, taken up at fair value. Going forward, no interest is accrued on the loan. Upon repayment, both parent and subsidiary reverse the entire entries made at origination. So therefore, first question is a beautiful question. You got to answer it in this fashion. In fact, I would like to answer it in this fashion. See, institute is just doing it in a one particular way, but I feel that it should be very clear. Number one, for first scenario, there is no term associated with the loan. There is no term associated with the loan. So to say that parent wanting to hold till maturity. There is no term associated with the loan. So to say that parent wanting to hold till maturity. To hence business model test fails. Both for amortized cost and fair value through other comprehensive income. So hence business model test fails both for AC and fair value through other comprehensive income. 3. See, there is some technical issue. I will just resume immediately after that. So suddenly it came out of the screen. Hence, business model test fails both for amortized cost and fair value through other comprehensive income. It shall be classified under fair value through profit and loss account. It shall be recorded at fair value at the inception and at all the times for both parent and subsidiary. There is no term associated with the loan. So to say that parent wanting to hold till maturity, hence BM test fails both for amortized cost and fair value through other comprehensive income. It shall be classified under fair value through profit and loss account. It shall be recorded at fair value at the inception and at all times for both parent and subsidiary. This is the way that you got to answer for the first part of the question. Scenario 1. Let me just check up. Yeah, scenario A. Then scenario B. What is that they have mentioned for scenario B? The loan is repayable after 3 years. The current market rate of interest for similar loan is 10% for both holding and subsidiary. So, in the first case, one important thing that you got to make note is that no interest is fixed because of no term associated. Have that in your mind, okay? That SPPA test is also not passed. So here we have this, the current market rate is 10% repayable after 3 years. So here 1, 2 and 3. Present value factor to be taken up at 10%. The cash flow is going to be 0, 0, and it is going to be, how much is that? 10 lakhs. Present value of cash flow. Total of that is 7,51,300. What is the entry that we are expected to pass in the books of parent? So debit, who is providing the loan? So it provides, parent is providing loan. Debit, loans receivable, 751,300. Credit is to be given to cash, 10 lakhs. What is the account to which we are expected to take up? Is it an asset or is it a loss? Is it an asset or is it a loss? So deemed investment is what they call. You cannot consider them as a loss. See, when it is a capital contribution, then in the books of the subsidiary company, how the same subject matter has got to be taken up? They got to consider as deemed equity. Just see, deemed equity. That is the way we are expected to take into consideration. So, in order to say that you will not be getting any amount of money, only then it is loss. So, it is deemed investments. In the books of subsidiary, debit cash, 10 lakhs, credit shall be given to loans payable, 741,300. Credit deemed equity as this difference. Okay. So this is at the inception, we are expected to pass this journal entry in this fashion. Okay. Then accrued income for year number 1, year number 2, and for year number 3, and the loan will be repaid. And now let us just take up the scheme in this fashion. Year number 1, 2, and 3. opening outstanding, interest, closing, because there is no cash flow. Interest is to be calculated at the rate of 10%. On this, apply 10%. Closing is opening plus interest accrual. So here it is going to be 10 lakhs. If that be the case, what is the amount that we are expected to take up? So the scheme of journal entry will be, this is at the inception. At the inception, this is a journal entry that we are expected to pass. In year number 1, we pass a journal entry in this fashion. Debit loans receivable interest income, so this journal entry is going to be same. Okay. So in the books of parent, this is a scheme of journal entries that we have got to pass. All these interest incomes are to be credited to profit and loss account. So interest income shall be credited to profit and loss account. Then debit cash 10 lakhs and a credit loans receivable 10 lakhs. Correct? And that is the way the scheme of journal entries in the books of the parent. On the same lines in the books of the subsidiary. So the figure of 248,700 and there in the books of subsidiary, it will get automatically eliminated in the consolidation. Debit interest expenses, credit loans payable. Correct? The scheme of journal entries will be taken in this fashion. Interest expenditure shall be debited to profit and loss account. Correct? And by that point of time, debit loans payable and credit cash. Correct? And investments and deemed equity will automatically get eliminated in consolidation. Deemed investments and deemed equity shall stand automatically eliminated in CFS. Correct. So scenario C is repayable when ABC has funds to repay the loan. So where there is no term that they have provided. Scenario C, generally a loan which is repayable when funds are available cannot be stated to be repayable on demand. It loses the characteristic feature of a liability. Rather, the entities need to estimate repayment date and determine its measurement accordingly. If the loan is expected to be repaid in 3 years, its measurement will be as in scenario B. In the consolidated financial statement, the loan interest expenses will be knocked off as intra-group transaction in all 3 scenarios. Hence, the above accounting change will not have any impact in CFS. However, if the loan is a foreign currency and exchange difference will continue to impact the statement of P&L account in accordance with the requirements of Ind AS 21. Just to show off that, or just to remind about if there were to be changes happening in the exchange rate, that will be affecting their profit and loss account is what they are stating. Okay. Now let us just take up. So now you can see financial liabilities on which you have amortized cost, fair value through profit and loss account only. You do not have OCI there. Now let us just take up on to illustration number 31. So after doing illustration number 1, we will have a break. Let's take up on to illustration number 31. Issue of borrowings with fixed rate of interest. A Limited has made a borrowing from RBC Bank. One moment. For $10,000 at a fixed rate of 10% per annum. Loan processing fees were additionally paid for 500 and loan is repayable after 5 years in bullet payment of principal. Details are as follows. Loan amount 10,000. Starting date 1st of April X1. Date of repayment of principal amount. Finishing date 31st of March X6. Interest rate 10%. Interest to be charged and paid yearly. Upfront fees 500. How would the loan be accounted in the books of A Limited? So, A Limited is a borrower, obviously. They have borrowed 10,000 rupees at a fixed rate of interest of 10% per annum. And the repayment will be bullet repayment. Bullet would mean only one payment towards the end. And effectively, they have taken a loan only for 9,500 and not for 10,000. That is what initial measurement that we are expected to carry out. So, for problems like this, we are expected to operate with a little amount of care, extra amount of care that we are going to do. Now, let us just try. A Limited is a borrower. And in the books of the borrower, the loan is expected to be recorded. It is a financial liability. Okay. So, loan amount 10,000. Transaction cost 500. Term 5 years. Rate of interest 10% per annum. So, effective rate of interest is matter of question. So, transaction cost is adjusted against the loan taken. So, therefore, for such cases, we are expected to use IRR function here. Cash flow minus 9,500. Then 10% on 10,000 is 1,000. Here it is 1,000 plus 10,000. So I will take up, yaar banda. It comes to 11.37%. Let me just check up how many years and all that. Yes. So 11.42 is what they are telling. Because they have interpolated with much larger numbers, they got this number. So ours is more perfect, 11.37%. So how normally under examination conditions that we do? See, here I am having Excel, I'm doing it under examination conditions, how it is to be done. So here 1-5 and 5. Cash flows are 1,000 and 10,000. Annuity factor or PV factor. So I prefer to take it about 11% because the rate of interest already committed or the face value rate of interest is 10%. So we will take it about 11%. I will take the calculator. 1 divided by 1.11 or 5 years. 1, 2, 3, 4, 5. 0.5935. It is 3.6959. Right. Then discounted cash flow 3696 5935 9631, whereas our target figure is 9,500. That means I'm expected to discount at a rate greater than 11%, so that I could just see that it is happening between 11 and 12. So annuity factor or PV factor at the rate of 12% when you take up. Point 5674, 3.6048 discounted cash flow. 3605, 5674. So it is 9279. For 1% change, it is having more than 300 as the difference. Now let us just check up. At 11% and at 12%, it is 9631 and 9279. At what rate it is going to be 9500? Eleven plus 9631 minus 9500 divided by 9631 minus 9279 into 1, which is equal to 11 plus 131 divided by, what is the difference it makes? 9631 minus 9279, 352 into 1. 131 divided by 352, which gives to you 11.37%. That is what you can say with accuracy through Excel function, it is 11.37. Now, from here we are, so therefore transaction cost are not to be expense, that are to be adjusted with the asset or the liability. So opening outstanding, then interest expense, cash flow, closing outstanding. $9,500 interest. So it is calculated at the rate of 11.37%. The actual cash flow for that is going to be opening balance plus interest minus the cash flow. How much is cost? So here it is going to be 11,000. The difference between the two, 1121, where the closing financial liabilities will be this much. How would the loan be accounted in the books? The scheme of journal entry will be debit cash 9,500, credit loan outstanding 9,500, and how through 5 years it has to be accounted. Is it clear? So we have just run through 5 years and we have come to a midpoint. We will take a break. Right. We will meet after 10 minutes. Okay. Thank you. Say, let us just resume the session. So that was illustration number 31. Then let's take up on to illustration number 32. Issue of borrowings with fixed rate of interest. A Limited has a borrowing from RBC for 10,000 at a fixed rate of 12% per annum. Loan processing fees were additionally paid for 500 and loan is repayable for half-yearly installments of 2,500 each. Details are as follows. Loan amount, date of loan, 1st April, 31st of March, EX3. Repayment of the loan starts from 30th of September, EX1. To be paid half-yearly, 2,500 installment amount, interest 12%, interest to be charged quarterly. Upfront fees, 500. How would the loan be accounted in books of A Limited? Consider IRR at 16.60%. So here I am going to take it up that that 16.6% is not provided there. So now let us just take up. So time frame, I will take it up. First of April, X1. 1st of April, X2. 1st of April, X3. Or 31st of March, X3. Let us take it up in this fashion. 1, 2, 3, 4. So in 4 half-yearly installments. So half-yearly number 1, half-yearly number 2, half-yearly number 3, half-yearly number 4. So principal repayment of 2,500, whereas interest is charged quarterly. So in fact, I will put the quarterly through another color. Correct. Interest is being interest 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 in interest interest, right? So here it is 10,000 minus 500, 2,500 repayment, 2,500 repayment, 2,500 repayment, and 2,500 repayment with whatever interest that accrues. Imagine that the effective rate of interest is not given, then how are we going to do it under examination conditions? So that is what we are looking into. So here they have mentioned that it is 12% per annum, a fixed rate of interest. I can as well do it through Excel, but I wanted to do it for the purpose of better understanding. Year number 0, where opening, interest, principal, repayment, and closing. So 9,500 only we can take up. Though the loan was there for 10,000, there is a transaction cost to the extent of 500, 9,500. Interest is to be calculated at the rate of 12% on the outstanding figure. The computation will be, so here we are not trying to find out the ledger accounts. See, our primary aim is to find out effective rate of interest. So working on number 1. So interest is computed 12% on 10,000 for 3 months period. So how much it works out to? 0.12 into 10,000 divided by 4. 300. Principal. No principal payment that you make. So I will put it this way. Instead of putting it out as year, I will put this as quarter number 1. Here, no principal. Closing is going to be 9,800. Quarter number 2, 9,800. It is 12% on. So I will put the case for as 10,000 only, because otherwise separate computation I got to go about. $10,300 into 3 by 12. 0.12 into 10,300 divided by 4. 309. 309 and 2,500 will be paid. So read the condition carefully. What is it they said? Repayment of loan starts to be repaid half-yearly, 2,500 installment. Interest to be charged quarterly. So that is what you have. 500, 9,500. So we have got so here they have done based on number of days. So one need not be just doing it like that. That is the reason as why I am taking it up a little differently. Number of months would be better, no? So that's the way we will normally be taking up. See how student will normally be thinking, that's the way I'm just doing. 10,300 plus 309 minus 2,500. 8109. Quarter number 3, 8109 into 0.12 divided by 4. 243 dash plus 8109. So 8352. 4, 8352 into 0.03. 251, 2,500 plus 8352 minus 2,500 should give you 6103. $6103. Whatever. $6,103 plus 183 equal to 6286. 66286 into 0.03, 189, 2500, 6286 minus 2500 should give you 3975. 3975 into 0.03, 119 dash 4094 8 4094 into 0.03, 123, and it is not going to be, let me just check up. $123 plus 4094 equal to 4217 and 0. Correct. All the interest that accrued were not paid off. Say now, this being the working note for the cash flow. Now let us just take up the cash flow. Cash flow is going to be 300 and it is going to be 2809, 243 and it is going to be 2751, 183 and 2689, 119 and lastly it is going to be 4340. Huh? How do you know? Shall we tell them? Say now let us just take up. That is working note number 1 for the purpose of finding out cash flow. Working note number 2. So term 1, 2, 3, 4, 5, 6, 7, 8. See, when we have in a class, we can just do all this exercise. Where is that? We shall tell them. Where is my calculator? This mobile. Surely born my problem. 300, 2809, 243, 2751, 5183, 2689, 7119, and lastly 4340. So cash flow PV factor so let us just take it about say 16% and discounted cash flow we are expected to have 9,500. Now let us just find out. 1 divided by 1.16. 0.8621. Last. No, last. 0.7. Say actually 16% per annum. So we have got to do it on a quarterly basis or 4% per quarter. 1 divided by 1.04. Point 0.85. Hmm.
Yeah. No, it's but actually it's not.
0.8219, 0.7903, 0.7599. Hmm? 17307. Oh, yeah. You take a photo, screenshot that also. 300 into 0.9615, 288, 2809 into 0.9246, 2597.
Should we log out from the session and come again?
இல்லைன்னா நாளைக்கு சேர்த்து பண்ணலாம் எடுத்து.
Okay, you could see the screen and the video. Okay, now the screen is actually. The problem is that the screen is not updating like that. Okay. He has actually wrote for 8 terms fully. Now the second, what I see is only for the second term that he has wrote. Only how it has come across it here. If I'll just exit and join. Exit and join.
So it comes to very big figure of 28494. But anyway, I will just try through Excel only. Now I will. So there were some technical snack. So I would like to redo that for your sake. So it is illustration number 32 that we were doing it. A Limited has made of borrowing from RBC Bank for 10,000 at a fixed rate of 12% per annum. Loan processing were additionally paid for rupees 500 and the loan is repayable in 4 half-yearly installments of 2,500 each. Details are as follows: 10,000 loan amount, date of loan 1st of April, date of loan finishing date 31st of March, description of repayment. Repayment of loan starts from 30th of September to be repaid half-yearly, installment amount 2,500, interest rate 12%, interest charge to be charged quarterly, upfront fee 500. How would the loan be accounted in the books of A Limited? So I would like to exclude all this and I'm just drawing it afresh. So cash flow statement. So quarter number 1 to up to 8. Okay. So base is 10,000. Interest at the rate of 12%. This into 0.12 divided by 4, comma 0. Why divided by 4 is that it is quarterly interest we are taking it up. Then cash flow, then closing base. This is going to be 0. Opening plus interest minus the repayment. This is going to be 10,300. This is 309. Repayment is going to be 2,500. 8109. Here it is going to be 0 because every quarterly, every half yearly principal will be paid 2,500. Correct. The illustration is 32. 2. So here it is going to be this plus this. Correct. So therefore the cash flow is towards interest and principal. Then quarter 0 cash flow is going to be minus 9,500. This into 4. So it is annually it is somewhere in the region of 28.49%. But in our institute, they mentioned as interest rate at 16.60%. So how they have arrived at? They have arrived at in this fashion. So they have taken up interest also that is getting paid. Let me just check up as how they work. Huh? Hmm? They have just made like that. Huh? We have also done like that. So just see 3, we have done like that. Because the problem is repayment of loan, installment amount 2500. See what they have just done. I'm Interest is calculated on quarterly basis. That is what they said. Interest is to be charged on quarterly basis. So how it is to be done? I am just doing it. 10,300 repayment is nothing. 10,300, and that being the opening, you calculate interest on interest. So in fact, I think I've done right 12% divided by 4. So it is 3% only I've done. Cash flow is 300. Next one is 309 plus 2500, 3809. That is what they have also done. Just see. 225, 2725. Hmm? No. In case a problem is not with that, how 16.6, here they have mentioned how 16.6 is arrived at. Consider IRR, how the loan will be taken up, because the solution ends here. That's a problem. So let me just check up. Here they have just gone in for number of days of on computation. Let me just check up how many. Say they have just demonstrated how 16.6% has come. There is maybe some computational error. Let me just check. It can't be that high. Four two one seven. That's right. Actually, computations are all correct. Even if they do by number of days, the percentage will not be affecting to that extent. Hmm? No. See, the purpose in this discussion is that how 16.6 is arrived at, because in the last problem, they have done 11.42. Actually, it was 11.37. See, it is an extension of the last problem only. It is exactly the same. That was for 5 years and this is for 2 years. Same thing. Anyway, I will just try it out one more time, because I find that computation somewhere I have just gone wrong. I will just take that matter a little later, because there is no journal entry that we would be passing. Now, let me just take up book back questions right now. Book back questions is coming up in comprehensive illustration that comes under Unit 7 end. Correct? No, that's not there. Under what head it is coming? Comprehensive illustration, separate section we have. Correct. We will take up that particular problem, illustration number 32, we will redo that. Illustration number 1, A Limited issued redeemable preference shares to a holding company Z Limited. The terms of the instrument have been summarized as follows. Account for this in the books of Z Limited. Repayment redeemable after 5 years. Date of allotment 1st of April X1. Date of repayment 31st of March X6. Total period 5 years. And value of preference shares issued is 100 million. And dividend rate is 0.0001% and market rate of interest is 12%. Present value factor is 0.56743. On the same lines as we have just done earlier case, we can just do in this particular case. So the question is about A Limited issued redeemable preference shares to its holding company Z Limited. Account this in the books of Z Limited. See, in the books of Z Limited is an investment, because issuer is A Limited, the subsidiary company, whereas the holder is the holding company Z Limited. In the books of Z Limited, it is an investment in other companies' equity or debt. So in this case, it is non-cumulative redeemable preferences. So it indicates that it is a debt. But what exactly we are expected to do is, we would like to know the initial value of the transaction. So market rate of interest is 12% and their PV factor is given. So multiplying this PV factor with the face value of the amount, you get the number as 56 million or 56.742, and the remaining amount has to be considered as investment in subsidiary. Remember that this sort of scheme of journal entries we have already passed here, right? So deemed investment and all that we have just already passed, something we have already done. So now we are expected to take up the opening balance as 56,742 and take up at the effective rate of interest of 12%, and so as to arrive at this value, journal entries at the initial stage on interest income, all that we can take it up right now. So this book back illustration number 1 now. Question number 1. Huh? So face value of the non-cumulative redeemable preference shares 100 million. Present value factor at the rate of 12% at year 5, given in the problem as 0.56743. Present value of investment. The difference shall be taken up as deemed investments. So the scheme of journal entry is deemed investment, equity component, loans receivable, this being loans receivable. Debit investment, debit loans receivable, and debit deemed investment or deemed equity for this balance. The credit can be given to cash. So now let us just run through 5 years. Opening outstanding. Interest income. Interest income, what is the rate at which it is to be taken up at? The effective interest rate is market rate of interest is 12% into 0.12, 0. Wrong. Cash flow, then closing. So here, this is going to be 100 million. This one is the difference between those two. This is going to be taken up as 0. So it was just taken up not at 56742, 686. So they have just run to the last decimal there. So whereas when you take it up at present value factor, there is going to be some amount of difference you would be getting. So please be careful on that. Is that right? So this is the journal entry by year 0. So year number 1, debit loans receivable, which this much of amount, credit interest income, then debit interest income and credit this way the scheme of journal entries will continue to be there. At year number 5, debit cash, credit loans receivable, this much. Say I am not taking up the intermittent portions because they are all understandable easily. Finally, so much of income and finally the bank to loans receivable. Correct? Shall we proceed? Then it is problem number 1 over problem number 2. A Limited issues 1 crore convertible bond on 1st of July 20x1. The bond have a life of 8 years and a face value of rupees 10 each, and they offer interest payable at the end of each financial year at the rate of 6% per annum. The bonds are issued at their face value, and each bond can be converted into one ordinary share in A Limited at any time in the next 8 years. Companies of a similar risk profile have recently issued debt with similar terms without option of conversion at 8% per annum. Provide the appropriate accounting entries for initial recognition. Calculate the stream of interest expense across the 8 years of the life of the bonds. Provide the accounting entries if the holders of the bond elect to convert the bond to ordinary shares at the end of the 3rd year. So now let us just take up A Limited issues 1 crore convertible bond. The life of the bond is for 8 years, face value 10, and they have just done it at 6% when rate of interest prevailing is 8%. See, whenever there is a company issuer or the holder, when they are booking loss, the other company is booking gain. So the gain or loss, when we understand prima facie, because when market rate is 8%, when other person had charge only 6%, so gain at the cost of the other person. So that has got to be captured in the in both the books. Otherwise, when we know, but when they are not recorded in the books, then our books of accounts will not have the reliability. So therefore, we are expected to charge at 8%. So what we are expected to do is that cash flows are to be taken up at 6%, but they are to be discounted at 8%. Illustration 2. How many years? 8 years, no? Cash flows 0.06 into 1 crore, no? So in fact, the last one is this with the principal. So PVF to be taken up at 8%. I corrected. See that open bracket I committed as a mistake. Discounted cash flow. So it is 88 lakhs 50,960 is the value that we should take it up towards loan, and the remaining amount has got to be taken for equity. So debit in whose books they wanted? In the books of A Limited. Debit cash credit convertible loan or convertible debenture with this value credit equity element. $1149,040 is the equity component or equity element. Then how the same has got to run for the periods where it is on annual basis. When you got to run for all that, year number 1, 2, 3, 4, 5, 6, 7, and 8. Opening outstanding. Interest, cash flow, and closing. Now, interest is to be charged at the rate of 8%. Round this into 0.08, 0. Cash flow is going to be this. What should be the closing? Opening plus interest minus the cash flow. So that closing becomes the opening in the next case. So there is going to be a marginal difference. So therefore, we will keep interest as a balancing figure. So that is what you find 784,692. 784,692 as a balancing figure. 1060 minus 981,5308. That is the way we arrive at. Is that clear? So we have answered to the first and the second part. Appropriate accounting entries at the initial stage and calculate the stream of interest expense across the 8 years of the bond. So last part of the question, provide the accounting entries if the holders of the bonds elect to convert the bond to that is ordinary shares at the end of the third year. So where there is going to be no amount that you would be having it in the form of repayment. If the holders of the bond elect to convert the bonds to ordinary shares at the end of the third year. So let me just check up with the question. When is that it is happening? So third year. Though it is likely to be taking place at the end of the 8th year in all our assumption. So here third part of the question where they say that they have the option of conversion at any time during the 8 years period. If the holders of the bond elect to convert the bond to ordinary shares at the end of the third year. At the third year, what would be the amount that we would be having in our table? So what is the amount of liability that you would be having? This is the third year in. So holder opts to convert by year 3. If that be the case, what scheme of journal entries that we have got to go about? So 72061 is the interest element. 726. So this is the one that we are expected to take it up. So all of you please have a close attention to this. So this is the amount of interest that we would be debiting, and actually we will be paying only 6 lakhs of rupees. The difference will go to the liability account. and this will make up this 726,061. So that point of time, the liability is coming to 9201,821, and ordinary share capital. So there is an equity component that we have initially booked. Remember that equity component that we have booked. So you have this much of liability. So debit is to be given to liability component. What is the name of that convertible debt? Debit. Convertible debt. This is the amount that you have. Debit. Equity element that we have. Equity component or equity element. So that will appear under statement of changes in equity in every year. And credit is to be given to equity capital. So that is what they have just made. Is that clear, all of you? So at the end of the third year, you should look into what amount of liability that will be outstanding. You got to extinguish the liability, and there is no need to have the equity element continuing to be there when conversion is taking place. So you are expected to close those liability, close those two accounts. One is liability, the other one being equity, and credit is to be given to ordinary share capital, that is equity share capital. Equity capital, and that's the way this entry is getting closed. Is that clear? Market order is very important. So we have just done two problems in book back. So this forward contract, we can take it up, illustration number 3. A little bit of IFM is getting involved alongside of that. Let us just go through that. On 1st of January, X1 SAM company agreed to purchase USD dollar 20,000 from JT Bank in future on 31st of December 20 X1. See, I would like to reserve this for tomorrow's class. Similar looking problem, we will crack it because we need to explain a little more onto that. So I would like to take up on to illustration number 6. Why? Because it requires a lot of explanation with the time that we have. So we have 15 minutes. It's better that we take up similar looking problems rather than new ones. ABC company issued 10,000 compulsory cumulative convertible preference shares CC triple CPS as on 1st of April 19X1 at the rate of 150 each. The rate of dividend is 10% payable every year. The preference shares are convertible into 5,000 equity shares of the company at the end of the 5th year from the date of allotment. When the triple CPS are issued, the prevailing market interest rate for similar debt without conversion option is 15%. Transaction cost on the issuance is 2% of the value of the proceeds. Date of allotment, date of conversion, number of preference shares 10,000, face value of preference shares 150, total proceeds 15 lakhs, rate of dividend 10%, market rate for similar is 15%, transaction cost is 30,000, face value of the equity shares after conversion 10, number of equity shares issued being 5,000, the effective rate is 15.86%. You are required to compute the liability and equity component and past journal entries for the entire arrangement from the issue of preference shares till the conversion into equity shares, keeping in view the provisions of the relevant Ind AS. See, here is a question of transaction cost that you have. And when you have cumulative convertible preference shares, you will have some portion of which for debt and some portion for equity. How the transaction cost will be divided between the two instruments is the challenge in this particular question. Okay. So component of equity that we will automatically be carrying it out. So the dividend portion multiplied by the effective rate of there is 15%, whatever they have just given. So you just get all that total proceeds. This is going to be equity component. So what happens is that when you have this being the component, that 30,000 is expected to be carried out and the net amount is to be done this way. So we are expected to arrive at the effective rate of interest. Our focus is not on equity, our focus is on to liability. So when 492,767 is the amount on which we are expected to apply, where the effective rate of interest of 15.86%, which is readily provided in the problem. So if it is not provided, how to calculate is what I just tried in the other case. So now let us just do that. And how the journal entries have got to be recorded. Mark this problem as very, very important. So that is the reason as why I told you similar looking problem will be very effective at this moment rather than cracking out to new problems. So it is illustration number 6. So 5 years project, year number 1, 2, 3, 4 and 5. The cash flow. What is the percentage they have mentioned? Percentage what they have mentioned is 10%. Equal to 10% into 10,000 into 150. PV factor at 15%. Present value of cash flow. So this is what you do have here. So when you are running it for so many decimal, every problem in which they do in a different style. So we will always keep 4 decimal into our component. So this portion is going to be liability. So total proceeds being to 150. So equity component. So when you have equity component that way, component, debt component, equity component, amounts are total of that being this. Transaction cost is 30,000. This is how much? Divided by this into into 30,000 around. So next one is this minus this. So the net of transaction cost. So 492,773 is the basis on which we are expected to compute. Year number 1, 2, 3, 4 and 5. Opening liability, interest expense, cash flow and closing. This is the amount. For this purpose only they have given you the effective interest rate at 15.86%. 15.86%. If it is not given, what is it we will do? So we will do through IRR. So when time is permitting, I will enter into that. Right now, I just want to borrow the information as they given in the problem, 15.86%. Cash flow is this. Closing is opening plus interest expenditure minus this. So this is what they have just done. 2506. Rounding off difference will always be there. Correct? Correct. How the scheme of journal entries that we are expected to pass for all through this. We're able to compute and through the entire scheme as how it is to be taken. You are required to compute liability, past journal entries for entire term of arrangement. So 5 years for which you have to pass a scheme of journal entries, and it is a repeated journal entry only. So only the numbers will be undergoing a change. Here 0 we have taken up. Year number 1. Debit interest expense 7814. Credit liability, then debit liability 150,000, credit cash, then debit P&L account, credit interest expense. Okay, this is one set. So likewise, 1, 1, for year number 2, interest expenditure year 2. Okay, and 5.3, this portion year 3, year number 4, year number 5. Then one more journal entry, debit liability, I'm sorry. Yeah, that we have passed. So these are the scheme of journal entries that we are expected to pass. So when it is a template and you can work out faster. So mark this problem as very, 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 very important. Correct? And equity component, equity share capital, and a securities premium. So that's the only last scheme of journal entries that we will be passing. Year number 5. Debit equity element that we have passed as journal entry here. So remember that this equity component that we have taken up. So net of that being 977, 277. Today, equity share capital. How much is that they mentioned in the problem that they will be converted with? They given you the indication 5,000 equity shares and face value is 10. So other equity component, there is security premium. Is that clear? So that's the way we will take up. Mark this problem as very, very important. 927, 233, 927, 227. So it is on account of approximation. Mark this illustration number 6 as very important. So they will ask this in the main examination. Let me repeat once again. They will ask this problem in the main examination. What is that technique or what is that problem that you're going to look for? So here is a place where you have compulsorily convertible preference shares issued. And that rate of interest is the rate of interest is 10% and effective market rate is 15%. By discounting that, you are having debt component and the balance being equity component, right? Which and so the transaction cost of 30,000 has got to be divided between equity and the debt component. And effective rate of interest of 15.86, which they given in the problem. So I was just thinking, why not I help you out in bringing out that number? 15.86. Supposing if that is not given in the problem, how do you do that? Here number 0, 1, 2, 3, 4, and 5. The cash flows are this number, inflows are this number. IRR 15.86%. Remember, I was just telling that we will take up that. That is the one that in illustration number 32, I said, if it is not provided, how do you arrive at? So even in this particular case, how do you arrive at? Now, let me just help you out. How do you arrive at? So manually, how do you work it out? No big deal. So here discounted cash outflow is 492,773. So cash inflow in each of the years being 150,000. Okay. So at IRR, see all of you please just watch out, see some amount of advanced financial management is required. At IRR, NPV is equal to 0. Discounted cash outflow equal to discounted cash inflow. This is 492,773. Discounted cash inflow is 150,000 into annuity factor that we do not know. So annuity factor is equal to 492,773 divided by 150,000. It should give you an annuity factor 492,773 divided by 150,000. That comes to 3.2852. So when you know that you computed for that particular case at 15%, so the effective interest rate should be a little greater than 15% or a little far off from 15%. So you can judge that it should be lying closer to 15%. So annuity factor at the rate of where you can say if your PV factor were to be 15% and at 16%, that is if your cost of capital were this, what will be the annuity factor for 5 years? See that under examination condition, you people can easily crack it. So 1 divided by 1.15, 1, 2, 3, 4, 5. Grand total is 3.3522, whereas we want 3.2852. See how under examination condition we can work out. That is what it is very important. 1 divided by 1.16. 1, 2, 3, 4, 5. Grand total 3.2743. So I want a number as 3.2852. So that gives me a thinking that we are coming close to, or it is falling between 15 and 16%. And at 15 and at 16. So it is 3.3522, 3.2743. At what rate it is going to be 3.2852? So it is 15 plus 3.3522 minus 3.2852. The whole divided by 3.3522 minus 3.2743 into 1. Now let's take the calculator and work them out. It's 15 plus 3.3522 minus 3.2852. So it is 0.067 divided by 3.3522 minus 3.2743. When you take up, that comes to 0.0779. So 0.067 divided by 0.0779, it comes to 15.86%. That's it. So under examination conditions, they might increase the challenge by not giving the effective rate of interest. That becomes a very important component. I am conveying to you, even if the problem is silent regarding what is the effective rate of interest, you can find out effective rate of interest. That was our seeking for that illustration number 32, 16.6%. Anyway, I will definitely take it up maybe in the next class beginning. Now, illustration number 6, book back is over. So mark this problem as very, very important. Now, with a lot of satisfaction, we can say that we have just done that. Now, this is book back, question number 1. So we have some more in comprehensive illustration that we will take it up in the next class. Now, we will take up on to question number 1. As part of staff welfare measure, Y Company Limited has contracted to lend its to its employees sums of money at the rate of 5% per annum rate of interest. The amounts lent are to be repaid in 5 equal installments of principal along with the interest. The market interest rate is 10% per annum for comparable loans. Y lent 1.6 million to its employees on 1st of January X1. Following the principles of recognition and measurement as laid down in Ind AS 109, you are required to record the entries for the year ended 31st of December X1 for the transaction and also compute the value of loan initially to be recognized and amortized cost for all subsequent years. For the purpose of calculation, following discount factors at interest rate of 10% per annum may be adopted. See, if that interest, there is PV factor is given, please follow that. So it comes to 3 decimals. So a company had provided to their employees at 5% when the prevailing rate of such loan in the market at 10%. So quite naturally, the company is incurring for providing the fund at 10%, whereas it is requiring only at the rate of 5%. So definitely company is at loss and employees are at gain. But we are not recording it in the books of the employees, but we want to do it in the books of the company. So how is this or how the problem has got to be done? The amount lent ought to be paid in 5 equal installments for the principal along with the interest. So here is a place where many times many authors used to have different or divergent views. So whether it is the principal amount is to be divided equally and or interest and principal to be taken up equally. So I'm going to take up the problem in both ways. See, in a classroom, we can just do that, but under examination condition, whether we can do it like that. So answer to that question is yes, we can do it, no problem at all. Now, I would like to try both ways because you cannot tell that there is straight line method is always right. That if you say that, then people following WTV, you have to put them under a wrong category. So therefore, we have to give equitable chance. We will try both ways. One moment. This book bank. Question number 1. Where they run for a period of 5 years. Opening, outstanding, interest, income, cash flow, closing, outstanding. So, computation of interest for an outsider, they are not really worried about what you are doing as financial instrument or anything. So, 16 lakhs or 1.6 million. Interest is computed at the rate of 5%. Cash flow. So here we are assuming installment is against principal and interest is separately paid. So that means divided by 5 plus closing is plus this minus this. And that becomes opening. So how this item is taken up? 16 lakhs divided by 5. How much it comes to? 3.2 lakhs. 3.2 plus 64, 384. Now, the PV factor that we got to take up is 10%. Round 1 divided by 1 plus 10% to the power, comma 3. Present value of cash flow. So this much is the advance. This much is only loans receivable. And out of 16 lakhs, this much is loans receivable. Then what is that? How is this difference we should take into consideration? Why would an employer do all this exercise by providing rate of interest lower than the market price? So why at all that love should come to a stranger? Can you tell? Why would an employer charge only 5% when he is incurring 10% to raise the money? What is the love and affection? What is the cause for love? Not employer-employee relationship. See, when a employee is taking a loan from an employer, naturally that person is tied towards employer. So if he wants to leave, he has got to borrow money and then leave. So therefore, the tendency of leaving will be coming down. So you are morally binding the other person. So therefore, you are having this as loan, and this 193,776 cannot be treated as equity. Reason is that it is not a transaction between company and the shareholders. It is a transaction between the company and the employees. So whether this can be knocked off in one stroke, answer to that question is no. So since you want them to be held or continuing to be in your employment for a period of 5 years, this amount can be taken up as prepaid cost, and that has got to be amortized. So prepaid employees cost, the balancing figure. So that is expected to be amortized over a period. So this is the first working notes that you got to develop. The first working notes that you got to develop. Working notes number 1. Then working notes number 2. What is that we are expected to do? Now I will tell you what we are expected to do. So opening outstanding or opening loans receivable. How much is that? Only this much. How much is the interest income? Interest income is to be taken up at the rate of 10%. The cash flow is what is the closing loans receivable. Opening plus interest income minus cash flow. So this figure has got to be altered then. So interest income has got to be booked to the extent of 433,776. This much of the income that you got to report. And please also understand amortization of prepaid employees cost. How much is that you will be taking? This divided by 5. Here, from this, we are expected to deduct whatever we have just done. So 1 rupee adjustment that we got to do. So 193,776 is getting adjusted. This minus this should give you 240,000, which is nothing but 16 lakhs into 5%. Not like that because principal is getting repaid. So you can't tell like that. That is interest income. I'll tell you what is that. That 240,000 interest income, correct? So this is on the assumption that installment is paid against principal and interest is separately paid. That is the way I think institute would have developed the answer. $14,06,272. 1406. One moment, let me just check up. Okay, so here I've just they are making it out as 751,683,620. Here it is. Correct. $193,728. 728. Prepaid staff cost is what they have mentioned. Okay. And staff loan interest expense 140,627. And this way they just ran for the full term. And we have just run that through the period. Now let us just take up now on to second question. Wheel Company Limited has a policy of providing subsidized loan to its employees. See, one thing which I have forgotten to tell you is that installment is against principal and interest is separately paid. So this is one assumption. So this is what one will normally be assuming. So installment, when you tell installment means both principal and interest. If that be the case, then how installment will be worked out? Installment that is equated annual installment, EAI, like EMI, it is EAI, which is equal to loan amount divided by annuity factor at the rate of committed rate. for 5 years. So if that be the case, number 1, 2, 3, 4, 5. PVF at the rate of 5%. EAI is going to be 16 lakhs divided by this number. So it is going to be 369,515 is the installment. Okay. If that be the case, how this problem will be handled? Closely follow. Opening, outstanding, interest, principal repayment, closing, outstanding. They have used a term as cash flow or opening amount outstanding is going to be this. This into 0.05. This is going to be this number minus interest. So here, hmm? So here I should have sorry, it should be 0. Correct. So this is the way we normally work this one, and our cash flow is going to be interest plus principal. Interest plus principal. So let me just check up once again. Now I have understood. The interest is not computed at the rate of 5%. It is to be done at 10%. So here it is going to be this minus this. Oh. Hmm? Hmm? No, here it just gone wrong. Interest is 5%, correct. Hmm. So there will be a marginal difference of 247 you will be having. So now let me just find out as how we can arrange that 247 to be adjusted against interest. So one moment. 369,515 minus 351,907. So 17,609 minus 247. 17,361. Right. So I have made the adjustment there in interest. Correct. So this is the way the interest our cash flow is going to be. Interest plus principal. Correct. This is the cash flow. Then PVF to be taken up at 10%. PVF we have already developed that number. Present value of cash flow. This number is 16 lakhs. Then prepaid employees cost is the difference between the two. Correct? This is loans receivable. Correct? Now, see why I am taking that time is that sometimes they may interpret things to that sort of thing. Opening outstanding loans receivable is this. Interest income at the rate of 10%. Then cash flow. Cash flow is going to be this closing outstanding lease rent, loans receivable plus this minus this. So this 468 we have got to adjust with interest income. Let me take it up. So it is 34018. Correct? So as how it was worked out that way, there will be a marginal difference that you would be getting. So you need to keep your options open and keep working out demand that is based on the situation that is demanding. So, okay, the rest of the problem in financial instruments and the remaining portions, we will take it up in tomorrow's class. And in the final class, we will be concluding with the accounting standards not done as far as with um, first time adoption FTA, we will be taking up or not one. Okay. Thank you. With that, we will just put an end for today's class.